That's TCS and what we should expect. We have Gautam Duggad who's with us. He's a market master of the day, head of research at MotilalOswal Financial Services. Gautam, good to have you with us here. Thank you very much for joining us. Gautam, I think I was looking at the earnings preview report for the season for Q2. For the full year FY25, I think you've brought down earnings expectations, EPS for Nifty, quite sharply. Correct me if I'm wrong, from about, 1320 to 1280 or so?
Yeah, hi Prashant. Good morning. Thanks for having me. Yes, your conclusion is correct. We have brought down the estimates by 4%. So there has been a 4% earnings cut for both FY25 and roughly 3.5% for FY26. So we were at about 1115 and 1315. It stands revised to 1070 and about 1270. So essentially, FY25 earnings now will be 7%, which will be the first year of a single-digit growth in last 5 years. So there is definitely a moderation out there, but there is a nuance to it. If you look at the earnings cut of 4%.
Gautam, Gautam, you said first time single-digit growth in
5 years.
5 years. That's what you said?
Yeah.
Okay.
So first time single-digit growth in 5 years. So what has happened, Prashant, is there has been a sharp cut in commodities. So for example, out of the 4% earnings cut that we have done in Nifty FY25, 80% of that 4% cut has come from 4 companies: Reliance, ONGC, Tata Steel, and JSW Steel. They account for 3.2% of that 4% cut. What it means is that the rest of the 46 companies put together have seen less than 1% earnings cut. More importantly, the broader coverage universe that we have, X of Nifty, which is about 225 stocks, they've seen less than 1.5% earnings cut. But the earnings cut look exaggerated because the 4 biggies in the Nifty have seen a slightly larger cut. So for example, Singapore GRM has been flat quarter to quarter. So Reliance has seen some cut in standalone, some cut in retail. And then you had a similar cut in Tata Steel and JSW Steel because the commodity prices for the quarter were a bit low. And at the same time, some of the expected recovery we were expecting in Tata Steel profitability in Europe, that got pushed out further. So yes, there is a cut. Yes, there is a moderation. But it's not a broad-based moderation. There are 3-4 companies which are driving large part of this cut.
Hi, morning. Just to go back, so you're saying 7% earnings growth in FY25, right?
Yeah.
That number really stands out because, last we spoke to several people on the street. I think the consensus was still in double digits. Some people were still talking about 13% and then talking about possible downgrade. So you're already, below street in terms of the consensus, right? Because yes, I don't know at these prices, at around even at 25,500 on the Nifty, I don't know if this 7% number is already baked in. Your thoughts?
Yeah, so Surabhi, look at it this way. We were at 1140 about 6 months back, right? So we had come down by 2% already in July. From there, we have come down by another 4%. Let me also hasten to add that this is the first year where we have seen the magnitude of cuts being slightly larger, right? Because post-COVID, we are not used to earnings cut. In fact, FY22 had seen an earnings upgrade. FY24 had also seen a marginal earnings upgrade. So we had seen about 15% growth in 21. Then that got uplifted to 40% because of commodity spike in FY22. In 23 again was a down year with about 12% growth. Then 24 again, we saw 25% growth. And this year we are at about 7%. So every alternate year, we have seen some sort of a moderation in earnings. But quality of earnings is not getting deteriorated sharply, Surabhi, because the cut is coming from commodities. Do remember, when the earnings upgrade was led by commodities, market didn't give it too much of a credit. If you recall, FY22 Nifty earnings grew 37%. But X of commodities in FY22, the earnings were up only 21%. Right? So market didn't sharply re-rate in FY22. Similarly, I expect when the downgrade is led by commodities, I don't expect any disproportionate impact on Nifty per se. Yes, it does damage the headline numbers, but there is a lot of layers to that 7% growth.
All right. Gautam, so we've got that. The past quarter is going to be a little bit subdued, but you're saying that for FY26, we'll see high teens growth, which evens out things to some extent. What about your preference on sectors? Some of the financials, private financials in particular, valuation-wise, they're pretty well placed. And also, they've not performed as much as, say, some of those PSUs. So what's your top picks sector-wise?
Definitely, Nigel. So if you see our model portfolio, we have made one big change this time. We've actually reduced the number of stocks in our portfolio from 38 to 31 and tried to increase weightages or concentrate our exposure in sectors and stocks where conviction levels are high. So one of the big changes we've done is we've taken private banks from underweight to overweight. Right? We've been underweight on private banks for the last 2.5 years, primarily owing to the underweight stance on HDFC Bank. Now we have made private banks overweight, where we have increased weight on ICICI, HDFC Bank, and introduced Kotak Bank in the model portfolio after a very long time, right? So that's slightly bigger exposure there. Private bank becomes underweight. NBFC and diversified financials are also overweight, and also PSU banks are overweight. So all three segments of financials in our model portfolio are now overweight, and they are overweight with a chunky, 400, 500 bips overweight. So from 31% index weight, we are at 35% now. And secondly, on IT also, where we had turned overweight in July, this quarter we have further increased that overweight from 11 to 15%. So in 6 months, we have doubled our weight in IT from 8 to 11 in July and 11 to 15 in October now, right? So these are two big sectors where we have raised our overweight stance substantially. Between the two of them, as you can calculate, this is 50% of our model portfolio now, BFSI plus IT.
Okay. So just to speak of IT in little more detail, Gautam, we're starting the season now with TCS, and I think what Rima was telling us, the expectations from TCS are actually of a slightly more sluggish quarter. I think the street is pitting higher hopes on Infosys this time around. How are you reading it? How are you reading it? How are you reading the trends? And I think there's some talk about while BFSI in the US is probably looking better, manufacturing in Europe, and we know, right? Auto sales, we know what's happening with the auto sector in Europe. That is possibly a concern. Your thoughts?
So, Surabhi, yes, Infosys will post, our expectation is 3% QOQ constant currency growth. So amongst the large cap, that's why our preference is towards HCL Tech and Infosys. If you see the composition of our model portfolio in IT, we have the highest overweight on HCL Tech for last 2 years running. And then we have Infosys in the large cap. And in mid cap, we continue to hold persistent and now have added Coforge. So as far as this quarter is concerned, we are definitely expecting some improvement in the commentary on IT sector. If discretionary demand were to revive, if not now, after another 3-4 months, I think Infosys will stand to be the biggest beneficiary. HCL Tech definitely has improved its free cash flow characteristics over the last 2 years, which is why we are giving it a slight premium to Infosys on valuations. Net-net, we think valuations on IT sector are at a stage where risk-reward is very favorable. And as far as mid-cap in IT is concerned, the growth continues to outperform large cap. If you look at last 10, 15 years of IT companies and compare the behavior of large and mid-cap IT on earnings growth and valuations, you would see that every alternate 2-3 years, the mid-cap IT used to go in premium and then fluctuate with discount to large cap. This time around, the premium of mid-cap IT has lasted versus large-cap IT for almost 4 years now. And one of the big drivers for that premium sustaining for so long is the continued outperformance on growth of mid-cap IT versus large-cap IT. As far as we are concerned, we've made it much bigger overweight now with both top-down as well as bottom-up perspective.
Okay. All right, Gautam, we will leave the conversation there for today. Thank you very much for joining, and we hope to keep getting you as the season progresses. Let's see how the earnings sort of finally play out and whether they can meet the lowered expectations that we're going with right now.